Welcome back to another roundtable. My name is Adam, once again with me, Rusmin.
Hello.
And Victor.
Hi everyone.
Thank you so much for joining us. And at this roundtable, we're going to talk about how you can make 5 figures in annual dividend income and whether that is possible. So, if you're a fan of dividends and you love passive income, this is the roundtable for you. All right. So before we begin, I think we want to show everyone that, whether this is possible, right? So what we did is that we ran a survey with some of our Dividend Machines members. So these are people that have come to our courses and they go through our process in how to invest in dividend stocks and REITs. And we gave them a survey and to just ask them anonymously how much they were making every single year in dividends. All right.
Yep.
So do you guys remember the results? I have it right here with me. Some of them, they were just starting out. So we did this for. We had 96 responders, all right? So 17 of them basically just said they were just starting out, all right? Some of them already started to make $1,000 to $4,000 a year, and some of them did $5,000 to $9,000, all right? And the majority of them actually was starting to make already $10,000 to $99,000, which is the 5-figure range. So if you see our stats over there, over 30% have already achieved that. And of course, 2 of them actually are making 6 figures in annual dividend income. All right, so these are real life results of people that we know, we've met and all that. So it's actually really, really possible. All right, so if that piqued your interest, there are real life people out there that are actually doing this. The question is, how do you do it? What are the steps? And then we're going to cover that today. All right, so how do you achieve a 5-figure dividend income?
First, you need $200,000, and then you find a stock that gives you 5% a year.
Okay.
That will give you 5 figures in dividends each year. Okay, that is about $10,000 in passive income.
All right.
Yep.
So, I'm straight away when you say something like that, a lot of people are going to ask you a question, but you just carry on with what you have to say first.
Yeah. So based on the math, basically you're going to get $10,000 a month, right? Yeah. So that
$10,000 a year.
A year, yes.
A month is different.
So that will kind of give you the objective, and of course, to hit that $200,000, at saving at one go, it's going to be shocking to some people, right? So some people may not have that capital right now, right? Yeah. But of course, it's always good to start somewhere, right? And so let's, for example, if you already have $200,000, okay, so let's assume that
maybe they're retirees or they've accumulated quite a bit at the end of their career and stuff
some
like that.
people really earn a lot of money and they save a lot, and it's not difficult at all for them to save $200,000, right? Okay. So I'm going to give you an example where if you have that stash of cash, right, hidden somewhere, and then you need to find a dividend stocks that gives you at least 5% a year. Okay, then you're going to achieve your 5 figures passive income. Okay, so the stock that I'm going to bring up is going to be a very easy and straightforward to understand, which is QF. It's a listed company in Singapore, and they are one of their core business is basically they sell bread, gardenia, right? So I think all of us are actually very familiar with gardenia bread, and this is a staple business where in good time you eat bread, in bad time you eat more. So these are the kind of stocks that I would say that is quite resilient. Okay, of course QF has other businesses, but I'll just try to keep it simple for this example, right? So and this company has actually been paying a very steady dividends, and this is a stock that actually has been paying a more than 5% yield over the last 10 years or even 15 years. Okay, so it has been one of the stocks that has 5 years giving out 5% yield or more.
So there's a track record of them paying this amount.
Yes, consistent track record.
Right?
Okay, so let's say 10 years ago, right, and then you have this $200,000 of stash of cash, and then you decided to invest in QF. Obviously, in dividend stock, we don't invest in one stock. You need to diversify across maybe 10, right? And you invested in QF, let's say 10 years ago, at a price of around, let's say, 80 cents. Okay, so this is in 2012, okay, and at the time QF was giving out a yield of more than 6% actually. Okay, so I'm basing it, let's say 5%, right? So if you invest in QF and you hold it until today, every year you're going to receive your $10,000. Okay, but actual fact you're receiving $12,500 each year. Okay, because at the time, based on the price of 80 cents, they were actually giving out about 6.25% yield. Yeah, so this is one scenario where if you have the cash and then you find a stock like QF, diversify them into 10 stocks, and then that's it, you achieve your goal.
Okay, but basically what you're saying is that even if right now, today, if someone wanted to go out there and start making that passive income, they can do it almost immediately.
Right?
Because there are stocks out there that pay 5%, and they're not risky stocks. They're actually pretty defensive, stable boring stocks like QAF. They sell bread. You eat bread.
Yes, and of course the current yield of QAF at the time of this recording is about 5.7% yield.
Oh, okay.
Okay,
right.
so we are not giving an example where hey, that was the yield back then, and then today the yield has compressed. No, it's still more than 5%.
All right. So no recommendation to go pick up QAF, anything like that, or buy gardenia bread or whatever like that.
Yes.
But it's just you're saying that this is already out there today.
Yeah.
Okay.
Okay.
All right. So the thing is, when you say $200,000, some people go, I don't have $200,000.
Yeah.
I'm just starting out, early 20s, maybe 30s. How do I get $200,000?
I think the $200,000 based on 5% to get $10,000 a year is actually more of like a theory. But when you do it really in investing, right, the amount is much less.
Okay.
Right. So let me show you an example using, let's say, this company called OCBC, our local bank.
Never
in
heard
Singapore.
of it. Of course, I heard of it.
Yeah, our local bank in Singapore. Yeah. So if you look at OCBC during the 2008 crash, right, they went from $9.70 all the way down to $4.11. Okay. So that's a like 57.6% drop from peak to trough, right? But let's say I didn't buy it at the best price. I just buy it at 5% yield at that point of time. So let's say I take 100,000, I buy 5% yield, and that will give you about $5.60. That's the price that you bought. And along the years, right, OCBC have been increasing their dividends, right, steadily from about 5.97% consistently all the way until 2019. Okay, 2020 is COVID. That's a one-off case. So we talk until 2019. So at 2019, right, the dividend that they give out is 53 cents. So that's about 9.5% yield on your cost that you invest. So let's say you invest 100,000, right? That will be 9.5% yield on your cost of 100,000. So you're getting close to $9,500 in passive income, which is very close to your $10,000.
Okay.
So basically, it's achievable, right? And that's the thing is getting the 100,000. Right, and also looking at companies that really pay dividend and increasing dividend. So the key thing is the dividend have to increase.
Okay.
Right, then you can increase your yield on cost over your original amount. So we literally cut half from the 200,000 to 100,000 already.
Yeah, so there's sounds a lot more achievable
right.
for most people. So if I were to bring back QF as an example, so I think last 10 years QF has been paying a very consistent dividend, right? And it's not growing. So Victor actually brought up OCBC as one of those companies where they actually increase their dividends along the way. Okay, so you want to find companies that can grow their dividends over time. Okay, so your yield on cost will keep on growing year after year. Okay, so even with a smaller base of capital, you can still hit the same amount of passive income that you're aiming to. But you have to wait. There's a wait time. Okay, it's not going to be immediate like your $200,000 you invest in QF, you sure get it in that year. Okay, you have to wait. I mean, you need to be realistic. If your capital is more, obviously you need to be patient, and the wait time could be like 5 years, 10 years, depending on stock that you actually invest.
But that's actually okay for someone who's still young and working. There's active income. You have the time to basically grow your income, save and invest. So, but the thing is about you can start now at whatever sum. You say $100,000.
Correct.
I know some people will think, can I do $100,000? But we talk about that as well. But basically over time, that the yield on cost will grow.
Correct.
It will become what you want.
Yeah, but the company have to grow their dividend.
And you
if the company is
right
a flat dividend, then your yield on cost will never grow.
So you got to pick a good dividend growth stock.
Correct.
Yes, yeah. So that's very, very important, right? You need to find companies like that and then you invest in them.
Okay.
And hopefully, over time, you grow. Okay. Of course, there are systematic approach to do that. Okay. So you need to have that system in place to find those stocks. Okay. Or it could be a REITs as well, real estate investment trust. Okay. So let me bring back to the same example, QF. So 10 years ago, they were relatively flat. But if you stretch out to 15 years ago, they actually have been increasing their dividends, right? When they were still very small at that point of time, right? So I actually did a math. If you invest right before the 0809 crisis, so you will those unlucky fella
just before the crash.
Just before the crash. Okay, so it happens to some people, right? So the capital to achieve the same goal as of today is $80,000 actually, right? So that time, if you go back to 2008, QF was trading at a price of about 40 cents. So if you invest your $80,000 at 40 cents before the crash, okay, you will be able to achieve the same goal as of today, okay, about $12,500 a year. Okay, so but back then, 2008, they actually increased their dividend from 2 cents, and 2009 to 3 cents, and then 2010 to about 4 cents, and of course 2011 to about 5 cents. Okay, so that incremental increase in dividends within that short 4 years, okay, or 3 years, you actually achieve that the goal. Okay. So this is where the kind of stock that you want to aim to find. Okay, QAF. Okay, but over time, QAF business have a few struggles, and there have been dividends have been relatively flat. Okay, but now this time around we are looking at a smaller capital base of $80,000 to achieve the same goal. Okay. So, and then the other scenario where you can achieve the same goal is even with a smaller base of capital, and that is $40,000. Okay. So, how to do that? Okay. So basically, you need to invest during the big crisis.
Correct.
Okay. So I talk about QF if you invest before the crisis, but after the crisis, QF share price actually dropped from 40 cents to 20 cents to as low as 15 cents. Okay, but let's be realistic. Okay, you can't pick the stock at the lowest at all time. Okay, maybe you pick at somewhere the low 20 cents. And that essentially, you get to buy the same amount of share versus you bought at 40 cents versus 20 cents, literally by half of the capital, right? Because you're buying at 50% cheaper. Okay, so by using $40,000, you will be able to achieve your dividends up to today. You're also going to get your 5 figures in passive income. Yeah.
And that's just based on one stock. And there are many examples out there.
There are many examples. Even I can bring in REITs and banks and all
banks
that.
Are super stable.
Yeah. So, but the point here is, of course, if you of course you need to train yourself. You need to learn how to, already have a list of companies that you have in mind. When the crisis comes, you hit hard. Okay, basically
strike when the iron is hot.
Yeah, strike when the iron is hot. Okay, so there are a few ways of investing in the stock market, right? One is you save out the year, you invest. The other one is you save up. You wait for the crisis and then you deploy that capital. And nowadays the crisis seems to be getting shorter and shorter every few years.
There's always an opportunity every few years to just put in a little bit of capital.
2 or 3 years.
Yes.
So far.
Yeah. So usually, typically, like COVID, you look at some of the REITs, the yield has gone up to 10%. Okay. So QF, back to the QF example, I think the yield at that point in time was as high as 10% yield.
Wow.
Yeah. So instead of getting a 5 to 6% yield in the normal time, crisis will give you that 10% yield, right? So, and in the good companies as well.
But you need to be prepared. So you need to know which stock to look out for at that point in time and actually take action.
Yeah.
And you have to have the right psychology and mindset to actually invest as well.
So while you save, it's always good to take the time to go and learn how to invest, how to pick the stocks, and then how to structure your portfolio when that time comes.
Yeah. Because I think usually what happens is there are two kinds of people. One is that there's a crash and they go, oh my God, what do I buy? But then by the time they do their research,
they're going to end up buying all the hot stocks.
Yeah. And then it's like, the other one is when the stocks go really high and they go, what do I buy? And they buy all the really expensive stuff.
Yes.
So you don't want to be like that. You want to just go in like with, prepared. So when the crisis really comes, you know exactly what you need to do. Yeah. And when bubble comes, you'll know exactly how to protect yourself as well.
Yeah, and one thing to take note is that dividend investing is actually very boring. You don't hear them in the news every day. It's not like your GameStop, that kind of drama, But it's very boring, and a lot of people has been doing that, right? And you just don't hear them. Yeah.
You don't hear them in the news. So I mean, I mentioned that banks were super stable, but of course they're a bit cyclical as well.
Yes.
So even then, even though like something like a bank, something a little bit cyclical, over the long term, the dividend has grown as well.
Correct.
Yeah.
Yes.
I mean, even if you bought, you see, I didn't give you guys the best price. I give you at 560 at 5% yield. Even you have bought at that price, you are still getting your yield. Even now is COVID, right? They are still trading above the 560. So the key thing is about dividend investing. It's not only about dividend growth also. You must buy into companies like Rusmi said, resilient, that you know that your share price either maintain or increase, but your share price don't go down. Because a lot of people they bought into not resilient company, right? And yes, the dividend yield is very high, but the share price will decrease because the company is very cyclical, right? Eventually, your capital loss cannot cover the dividend that you receive, right? So that's the thing that we want to look out for. So for the banks, even though they are that cyclic, but they are cyclic on the uptrend, right?
Yeah.
And right now, I think today's price is $13.33 around $13. OCBC, around 13 plus. Right?
So you guys talk about the bank, right? Actually, bank is very sensitive to the interest rate. Okay, that makes them a semi-cyclic stocks, and the best way to hedge it is buying into REITs.
Okay.
Right. So REITs are also sensitive to the interest rate hike. Okay, so in the time where interest rate was going to rise, REIT generally prices will come down, but bank will go up. But in the event when the interest rate is going down, bank prices will go down, the REITs will go up because lower cost of borrowing.
And both of them pay you dividends.
Both of them pay dividends, so you kind of like hedge them together. Instead of like 10,000, let's say you have 10,000 to invest in OCBC, now you can break it up half into REITs, half into the bank. They kind of sort hedge
Okay,
one
I
another.
think that's a really good point.
Yeah.
Yeah. So I think the thing is, when you say like $40,000, $100,000, actually that's pretty achievable for most people if you're working, right?
Yes.
So I think I did some research on this. Is where basically I think the median income for a university graduate in Singapore, it could be different in your country, but in Singapore, the median income salary is $3,700. So by the time you hit 30, you would have saved up at least $100,000 in your CPF, in your savings account at 2.5%. It's actually super achievable. So even if you don't if you spend, you only put in the CPF, you spend everything else, you would have 100,000 in your CPF. But that's CPF. So actually, if you started to save on your own, having $100,000 by 30 is actually very, very achievable.
It's very achievable.
And that's one of the goals of FIRE, right? FIRE.
Yep.
Basically, you want to FIRE, retire early.
Financial
independence,
independence,
retire early and all that. The goal is to hit 100,000 by 30 at least.
Yes.
And then you go on from there.
Yeah.
And actually, if a lot of people, I think a lot of people have done that.
Yep.
So if you think that $100,000 is such a big thing, it's actually doable if you work out the sums. And then, like you say, if you invest in, dividend growth stocks like the banks, you hedge it with the REITs, and you like the passive income, you can do it.
Yeah. I think you should build your first 100,000. It's very, very important. I mean, Charlie Munger say your first 100,000 is the most is the building block for your investing moving forward.
I mean, if you can't make it to 100,000, then I mean, maybe your life circumstances are unlucky. That
Different,
happens. But you should be able to get 100,000.
Yeah, you can do side hustles and a lot of other stuff you can do, your part time.
Of course, of course, if you're dependent with you, it's a lot harder. And of course, you have that kind of situation. You have to compensate by working harder. More time to work.
So everyone's situation is different. We don't pretend to know, but please, have a look at your finances. Find out what makes sense for you, what works best. Work out the sums, and then you have a goal to work toward too. Yeah.
Correct.
All right. So I think, of course, the best thing in for dividends, especially in Singapore, is that it's tax free.
Yes.
In Hong Kong, it's also tax free.
Hong Kong stocks as well, tax free. Singapore stocks, tax free.
Malaysia is also tax free, actually. So only for REITs, you have some withholding tax.
Okay.
10%.
Yeah. So not for US dividends if you're a foreigner because of the 30% withholding tax. But if you're American and you live in the US, you have some great dividend stocks as well, the dividend aristocrats. Very, very powerful companies as well. But in Singapore, tax free. So that's the great thing about dividends as well. Everything is yours. You put in your pocket. All right. So I think that's a pretty good wrap up of how you can basically, we show you the steps on how you can actually make 5 figures in annual dividend income. It's not something that's just pie in the sky. The actual math behind the actual process, feel free to watch this video again. You'll listen to the whole process again and listen to our voices. And then, of course, I think this is a pretty good summary of how you can do it. All right. So once again, I mean, if you want to find out more about, how to invest in dividend stocks and REITs, feel free to check out our Dividend Machines course where we teach everything about that. All right. You want to tell us a bit more about that, Rusmin?
But basically it's a course to teach you how to do the financial planning. There's one under the personal finance. Of course, we also have, methods where I can teach you how to find those income stocks like QF as one example. And then, of course, not just one, but multiple of, you need to find a few of them and diversify your portfolio because sometimes things can go wrong. So that's why diversification comes in very handy. And of course, Victor also covered very in depth on the Singapore banks and the history of it and why Singapore banks are not stable in general. And of course, we do a deep dive into REITs, real estate investment trust, on how to pick the best REITs to invest for the long run. Okay, so you want to choose the best quality, right? And then those REITs that can give you consistent dividends and also growing dividends year after year. Okay, that is actually very important. And most important part is you need to know when to invest, right? When to buy and when to sell so that you get the best optimum return.
All right. So if you're interested in dividends, if it's always been your thing, you want to have some passive income, do check us out at dividendmachines.com/YouTube. And if you go to that link, we have a bonus for you as well. Basically, it's a list of all the Singapore and Malaysian dividend stocks that actually pay consistent and growing dividends as well. We compiled that and put it all in a PDF for you. So if you go to dividendmachines.com/YouTube, you get that bonus as well.
Yeah, the list, if you were to go through yourself, I think it's going to take you months to come through the whole list.
Basically done it for you. So this dividendmachines.com is only open once a year to the public. So we typically do this once a year, right? And if you miss this round, the next round will be in 2023. So at this point, wherever you're watching this will close on the 6th of March at 6th of March 2022, which is on a Sunday.
Yep.
Yeah.
All right. So, we don't really ever promote stuff on this roundtable, but if you really want to check this out, you love dividends, do check us out on dividendmachines.com/YouTube and get that bonus as well. All right. So once again, thank you so much for joining us. My name is Adam. That is Rusmin.
Thank you.
This is Victor. We
Thank
hope you enjoyed this roundtable on dividends and how you can make 5 figures in annual dividend income and process to do that. Again, any questions about dividends you want to ask, put them in the comment section. If you like this video, feel free to hit the like button. Tell us you're doing a great job. Of course, subscribe to our channel. Many more roundtables coming up again. So